Exit Teams podcast, where business owners and their advisors get real world insight on how to build a team of advisors, maximize value, and exit on their own terms. I'm your host, Bob Tankesley, the author of Exit Teams, Build a Team of Advisors for Your Business Sale to Get a Higher Price. You can find that book and all kinds of content at our ongoing media project website, exitteams.com. Whether you're years away from selling or thinking about an exit now, this episode is packed with must-know tips to help you avoid costly mistakes. So let's dive in. Today, I'm joined by a true expert in the world of business valuation and financial clarity, my good friend, Gregg Ficery. Gregg is president of Integgra Valuation Advisory Services, which he founded in 2011. He has over 20 years of business valuation consulting experience and has valued over 1,000 private companies. Gregg, that's about one per week, if my math is right. He also has over 10 years of industry experience in the technology, telecommunications, and financial services sectors in finance, accounting, and corporate development roles. Well, excellent. Gregg, thanks for being here. You and I have known each other for quite a while. We go back, 5 or 6 years at least, the founding of XPX Atlanta. How you doing?
Great. Thanks for having me on, Bob. And I know we're friends if you can say Ficery correctly. So thanks for that.
Yeah. With a last name like Tankesley, I'm very sensitive to the pronunciation of people's names. Hey, let's start at a very fundamental level. Expert in valuation for businesses that you are. How are businesses valued? Because we're not talking about publicly traded companies, right? Where buyers and sellers, are functioning on an open market and there's lots of price discovery and lots of information being processed. We're talking about privately held companies with almost zero visibility to the outside world. At a fundamental level, how do you look at business valuation?
Right. So as you said, they aren't publicly traded, on a daily basis. So you don't have visibility, and there's only certain points at which companies need to know what they're worth. Maybe if they're have been or have received investment from a VC, they might have to be valued quarterly by the VC or the private equity firm. But for their own purposes, there are only certain points when they need to know. So I like to start by describing the life cycle of a business to just touch on those points. And the first point is usually when they're raising money in a Shark Tank type situation. So they need to know, how much, I need $500,000 at X valuation, and how do they figure that out, especially if they're pre-revenue, and that's even the most mysterious type of situation. And then once they raise money, they might need to issue stock options to employees, and they need to have strike prices. So then they'll need to go through that exercise, and that's
I'm
called
seeing quite a bit
409.
more interest in that.
Right. It's the only valuation that's done on a regular sort of annual basis, or more often if there's a material event like a fundraising that resets the price. So that's my sort of niche, actually. Many valuation providers either don't know how to do those or don't do them very well. They're just not familiar with how to value the really early stage companies. So I do lots of those. Then later come, partnership buyouts and various types of disputes or M&A type situations. And there's certain tax and financial reporting situations along the way, also requiring valuations. In the end, maybe 10 or 12 different things. Even post-transaction, there can be fairness opinions, there can be IP valuations at some points, but sort of more niche. But so that's sort of why. In terms of how, it depends on the stage of the company, in terms of the methods that we would apply. And you can think of it commonly in terms of being similar to a home appraisal or real estate appraisal with cost, market, and income approaches. And especially the market approach is the most common in real estate. So you think about comps, right? So you have homes in your neighborhood, zip code, size, square footage, and so on. And in business valuation, that means comparable either public companies that you have access to their financials on, or private companies that have been sold. And so we have databases of private company transactions we can access for the valuations on those. But the best method for, and most accurate really, for private companies is the income approach, because it's specific to the company we're valuing. It's as opposed to somewhat dissimilar comps that can be all over the place in terms of their revenue multiples or EBITDA multiples that we would use. So, and then by definition, the most salient point is that the value of any company is the present value of its future cash flows. So we're relying, not on the past, but on the forecast that the company provides, and then totaling the cash flows, or, not net income technically, but EBITDA, earnings before interest, taxes, depreciation, and amortization, and then discounting them by some perceived forecast achievement risk that we apply from our experience to discount that total. And then we like to triangulate that answer with confirming values from the market approach, just to say, what implied multiples are there from this income approach within the range of multiples from the comps, to say, does this just make sense? Is it at the median, sort of the higher end, lower end, or outside of the bounds of that range? And then if they're too far apart, if the implied multiple on the market approach doesn't make sense, then we just ask ourselves what's off, and we might want to change a discount rate or something else on the income approach to bring them within, a reasonable margin. But that's really at the most basic level. If a company's profitable, we can't discount negative forecasted cash flows, and many early stage companies aren't yet profitable. So we got to throw the income approach out, and the EBITDA multiple approach, because you can't apply, an EBITDA multiple to a negative cash flow in a forecast. So then we would revert to earlier stage companies that at least have some material revenue to a revenue multiple method within the market approach. And that's not ideal, but it can be all we have a lot of times. And then finally, as I referred to earlier, if you have very little to no revenue, you can't even apply a revenue multiple to those. And we have another method that we call the Scorecard method that has been written about in academia, and we've sort of created a model out of that to assess a company and apply a score to it, kind of a multiple to funding data from other around the country on, so starting with for example, a median national funding amount for angel stage companies. And we have to search for that, and there's databases that publish that kind of thing, and they might not even agree with each other most times, but then we still have the slight, peel back the onion on that and break it down to not just a national average, but also within the sector that the company's in, because SaaS software companies have higher multiples than business to consumer type, products. And
Sure.
so we have to ask ourselves, what sector is the company in? What region? Because companies in the Valley and the tech hubs get higher valuations than others. And then finally, even the time of year when you're valuing the company, or the valuation date, especially if it's later in the year, the market may have moved quite a bit from the last year when you had funding data. So you have to come up with an adjustment for that, and we have tools to do that. So it's the best tool we have, the scorecard method, to come up with a less subjective value or the most objective value we can, and it's pretty satisfying for clients to go through that exercise.
Yeah, we'll talk offline after the show is over here. But you're reminding me of someone who just brought a concept to me involving AI, and I think I'm not going to try to value him, but it sounds like a scorecard method might work as well. In terms of exit transactions, for lower middle market companies, because all that you just described, there's a lot of complexity, there's a lot of subjectivity that runs through the business valuation process. Who's looking at it? What's the purpose of it? What are we trying to achieve? And so I'm sure there are some common myths that business owners have as they're trending toward exit. Some common myths about the value of their own company. What do you see out there that tends to create obstacles for them for actually getting a deal done? Because I say this stat pretty often. About 20% of companies are ever taken to market, and about 20% of those ever transact, leaving us 4% of small businesses that ever transact, plus or minus a percentage point. But I think a huge reason for that is a disconnect between buyer and seller about what the value of the opportunity represents.
Exactly. In a word, I would call that expectations, right? So, and each side's expectations going into a negotiation. So a seller's expectations, no surprise, are often far too high. And if they're, unreasonably high, that's going to be a reason to disconnect from, discussions and negotiations off the bat. So they're not even going to want to go into spending the time for due diligence if they just don't feel like there's, a reasonableness in the initial offer. Just like selling a home, if you price yourself out of the market, you're just going to turn off a lot of potential buyers. So the question is, where do those expectations come from? And a lot of times it's just from like, well, I hear that, our sector, the revenue multiple is 3x, so the first thing, so that's first of all, as I said, the market approach is disconnected from the income approach and the specific performance of your company. So they might think that, okay, by default, we should at least get the average or median, revenue multiple, and apply that to our revenue. Now, a couple super important things. First of all, there's a very, very strong, like 99% of the time, we see a correlation between the size of a company and their multiples, with smaller companies driving lower multiples. So if that market multiple that they've heard is, from public companies that are much bigger, they're oversetting, their expectation right off the bat. So, and oftentimes it's companies with billion-dollar valuations that are driving, they especially in SaaS software, there was a 10x revenue multiple myth going around for a long time, and still maybe. But when we put our, data together, and I, passionately dug in because I had to have that conversation a lot, is where's that coming from? That 10x number often doesn't, surface until companies are worth about $2 billion. So if you got a nice, even couple $100 million company, let alone, less than 100 million, you're going to be far less than 1 times revenue most of the time. And that's pretty shocking to a business owner that's excited to, buy their retirement home and boat and whatever else is on their wish list. So that's the first thing. And then second, revenue multiples compared are much, much less accurate than EBITDA multiples, because companies' margins, their EBITDA margins, vary widely depending on how they're managed. And one of my favorite examples is a partnership buyout we negotiated one time within the digital marketing space, and the minority ownership partner owned about a third of the company, was leaving. Let's just say, make up a number, that they were had 5 million in revenue. And the minority partner comes and says, okay, I hear we have 3x revenue multiples, so we're worth 15 million, pay me out 5 million and I'll be gone. And the CEO says, wow, like 5 million? No, I don't have 5 million, we're not worth 5. So once we get into the income approach and seeing, even within sectors, there are different business models. In digital marketing, which is very hot, you've got more agency type consulting models that are lower margin, and then more advertising kind of models that are much higher margin. So that was a big lever. And this particular company was an agency. And once you got into the income approach and how they're managed and all their expenses, and while it's a great company, the margins were relatively low, and the thing came out far without getting into confidentiality, like a fraction of that initial
Wow.
ask. So that is just a great example of why you want to look at EBITDA multiples instead of revenue multiples. So yeah, size, correlation, and EBITDA, those are two of the biggest myths or sort of red herrings or flaws in sort of expected valuations.
No doubt. I can't tell you how many times I've heard an owner ask, well, what do you think my company's worth? And I'll just ballpark it very, very back of the napkin, because we have to sometimes go to market with a price. Usually we don't, but we need to know what the range of offers might look like when they come back. And I'll give him a number, and he'll say this can't be the case. So about 3 out of 4 times, it's not the news they're expecting, which raises the question. You would think, rather than it be a 11 p.m. on a 24-hour clock, rather than wait till just before closing when we're deep into due diligence, you would think that business owners would want to know the value of their business, the value of this 60+% chunk of their net worth. You would think they'd want to know it years in advance instead of, in the 11th hour, literally. You have any thoughts on that? Have you ever done, well, here's a question. Have you ever done a series of evaluations for an owner that was really forward thinking and said, I want to exit X number of years into the future, and then benchmark value and then just kind of annually or biannually thereafter?
Sure. If they're doing the 409A option pricing valuations along the way, then they have some sense of that. But some, probably a minority, less than half, are not issuing options if they have a substantial number of employees. But if they're not doing that, then some do want to think about that ahead of time, and if they have goals or things that they want to accomplish after selling the company or target, the the better ones or the wiser ones will not want to be surprised after they hire an advisor like yourself to start going through the process. And then they want time to course correct if there's something off, and benchmarking is an important piece of that. They can see, especially for smaller companies, the private M&A transaction databases can be more helpful because they're more similarly sized companies, as I mentioned. And that's a great indication, but we can't often get as much granularity in terms of margins and things like that, financials, as we can from the public companies. So we can also look at those and say, well, your growth rate or your your margins are higher or lower than, the range of your comps here. Why is that? Great if you're growing faster, which is typical based on just the law of large numbers for smaller companies. But margins, if they're not keeping up, they can ask themselves, why is our OpEx so much higher than these other companies? I mean, maybe they're not as efficient yet, but what can they be doing? What can they challenge themselves on to increase their margins? Because companies are paying for cash flow. They're that is it. When somebody says, what can I do to increase my value? You can increase your cash flow, and that's a byproduct, many times of increasing your revenue, but it doesn't have to be. If there are ways for you to trim expenses, if you're not growing, which is very common, in this economy. I mean, companies have struggled mightily to grow their revenue and have had to go into expense harvesting, especially if they're losing money and are struggling to raise money in this environment.
I do a fair amount of networking here in the Atlanta area, and I'm starting to run into more and more folks that, work in the expense management, expense reduction field. And I tell them, hey, a pitch to your business owner clients might be for every dollar you can save them that hits the bottom line, maybe put a 3, 4, 5x multiple on that. Who knows what the multiple will end up being. But if these expense containment people can find money, it's additive to value. While we're talking on financial statements, the P&L, being a significant driver of what buyers look at, do you sometimes um, advise clients on what buyers are going to be looking for on those financial statements? In specifically, I'm thinking of, normalizing adjustments. I'm thinking of, presenting financials back 5, 6, 7 years, to kind of get back into those pre-COVID years. But I would imagine you don't just take financial statements at face value from the owners. They're running a lot through the company. I've seen the boat, the plane, the multiple cars, the vacation home, the kids' college. A lot gets run through, and other things get run through financial statements. But talk a bit about that. Financial statements are a great place to start for sellers to understand their companies better, and for buyers to understand the opportunity better. But there's a lot of work that often needs to be done to them to get them in a comparable condition.
Right. So when you say run through the company, or those are the perks of owning your own company, that's private, and there's gray areas that everybody wrestles with themselves in terms of which expenses to claim. And the 9/15 partnership tax deadline just passed, so went through that myself. And when you're representing the company for sale, you need to represent. What the term normalize is a little unclear, but what is normal, or for a buyer, if you took out those kinds of things that are personal. So, and you really want to do that because that increases the value by adding those back and increasing your profitability. You're showing what the company would make under normal circumstances or fair market value. So, while some people, want to get their net income as close to zero as possible to pay as little tax as possible, perhaps it's really worth, substantially more after making those adjustments. So that is really important. I can't really advise them on, I might be able to recognize a few line items, many of which you mentioned. Others include having certain, family members or whatever on the payroll. And, but they're going to have to sort through that themselves. But related, also, you know, we present and encourage them to think about the difference between that fair market value and the strategic value in a potential acquisition, because there are synergies that buyers with
Yep.
related businesses can realize and are willing to pay for in a transaction. So in a negotiation, my opinion as a business valuation consultant, in that situation where there's a transaction that it's going to be negotiated, and will likely include some strategic value, will be different than a fair market value opinion that I might issue for stock options, for example. So I will say, look, you don't have to offer the company out on the fair market value number. Let's think about, from a potential buyer's perspective, how much more could it be worth under those circumstances? And obviously that can be huge. So, that's part of the consultative process in a transaction situation.
Yeah, I'm often taking companies to market with about a minimum $5 million transaction value, sometimes approaching 30, 40, 50 million. And more times than not, a lot more times than not, we're not going to market the opportunity with a price tag attached to it. We want to hear from the buyer pool what they think the opportunity represents to them. But as I said earlier, we definitely have a better we have an understanding of what the range of offers should be, and hopefully that matches up with the seller's expectations. But we get to sanity check any offers that do come in. Folks, we're talking with Gregg Ficery of Integgra Valuation Advisory Services here on the Exit Teams podcast. And as a reminder, you can order this book on Amazon. Just start typing Exit Team, should be the first hit. Gregg, you mentioned the opportunity to increase value over time. I'm finding buyers are digging deeper. They're asking tougher questions, and their due diligence is getting a lot more granular. But the ones that, as you said, are in it for strategic purposes, they hang in there. They give us some of the better offers. Have you found this? There could be some business specific, some business model specific insights you could give, but broadly speaking, have you found there are better ways that owners should focus on, better areas of their business that they should focus on to increase the value of their business over time? And people often ask me, as you think about that, I'll mention people often ask me, how long does it take to, get a company ready for market? And I've kind of landed on 3 years. 3 years is long enough that you can impress your future buyer and their provider of capital that the changes you've made are sticky enough, and that value enhancement has been in place long enough for it to be transferable. But 3 years is not also too long that you're going to burn out your seller having to pay for all these improvements and all these advisors and professionals and other folks to come in and help them grow that value. But have there been some key ways that you've noticed, oh, this and this and this, these things move the needle the most for ramping up value over time?
Kind of a tough one. I'm not sure that's not something I get involved with a lot, but the most obvious ones are your cost of goods sold and your operating expenses. I mean, if you're not, sales strategy, I mean, obviously I can't tell them how to, increase their sales, but it's easier to look at your expenses that you can control and assess, are there ways to reduce them, without impacting the quality of the product or the service, but on the COG side. And then going forward, I mean, not as much historically, but now the big question is AI, and how how can AI be leveraged to reduce some expenses, which might increase value substantially. So encouraging people to look into that. I think it's still in the early innings of being able to do that, but I think that's going to be a big driver going forward.
Yeah,
Yeah.
I agree. The AI kind of feels like the internet in the late 90s. It's this shiny new toy that we all get to play with, but we haven't quite figured out what to do with it. Greg, what do you need for any business owners listening or advisors that have business owner clients who they think really need to get a handle on their business value? What do you need from a business owner to literally value a business? How long does it take? Roughly what does it cost?
Right. Those are the most often asked questions for sure. So it can seem onerous and hopefully not prohibitive to a potential client to go through the process, but it's really not as bad as they might think. So all we really need to get started, just to start the process, is a quick engagement letter on DocuSign, and then the invoice and the document request list are included from the get-go. And one interesting thing about valuation is we do need to charge up front for the service, because sadly some clients don't like to pay if they don't like the answer. So there's a certain matter of independence involved there. It also eliminates receivables, which helps us sleep better. But that's something that needs to be understood from an objectivity and independence standpoint. But all we need, depending on the circumstance, if they just need the 100% value of the company, we need a few years of historical financial statements, which income statements and balance sheets, not even cash flow statements, and up to the year-to-date ones if we got a mid-year valuation date, and a forecast. So not much more. That's about it for 100% level. But then, and more when you've got a complex capital structure and you've got to get a per share value, especially for option pricing, then you're going to need the cap table and the articles of incorporations or shareholders agreements, and an option table if options have been issued before, because getting to the 100% value is only the first step. And then you've got to allocate that value through the different share classes. And if there's more than one, you've got to use the Black-Scholes option pricing method, which is a lot more work than even just getting to the 100% value. So that's basically, there's 6 or 7 must-have things. It's nice to get suggestions on comps, public or private transactions. It's nice to get any internal modeling or previous valuations from other providers or pitch decks, anything, discussions, negotiations that have been going on, those kinds of things, but mostly nice to haves. So it's a pretty quick pre-valuation process to go through. And then once we have we say sign, pay, and post the documents. It takes us about 2 weeks or less to do the initial draft, and we'll ask questions along the way, and then we'll have a screen share call and we'll walk through it together. And we're not just opining from the White Tower and saying that's the right out of the gate that's the answer. We want their input and make sure we thought about everything the right way and that their input's included. And then once they sign off on the number, if they need a write-up to go with it for any official purposes for the IRS or investors, whatever, we'll need another week or two to write up the report. And that's usually 20 or 25 pages. And it's an option that they have in the fee structure. So it's all a month or so, we're faster if everybody's on their game. And the fees, most important question to most clients. It depends on the purpose of the valuation, which implies the complexity necessary. So, um, in an early stage company pre-revenue, that scorecard method, it's not as much quantitative analysis going on. It's probably just a couple $1,000, and then advancing up to the 409A and the option pricing exercise depends on who your providers. Larger ones than my firm with a lot of employees and overhead these days, used to be 7 or 8 and to 10, and now I'm hearing 10 to 12, or in some cases even the bigger city firms in New York. I'm having a lot of success bringing down south because they're paying $25,000 for
Wow.
an option pricing valuation. So we try to keep them around 5,000, to maybe a little more for the Series C, D, like more complex capital structures.
Right.
But I mean, 5 to 10, at the highest. And then, tax related valuations when clients are donating, transferring shares to trusts or for charitable purposes. And, there's a little more risk and exposure and audit time involved with those kinds of things. Most of my friendly competitors these days, I hear, are in the 12 to 15K range, and we still try to stay, between 7 and 10 on those. And the more back and forth there is in negotiations and partnership buyouts and mediations, or it's can be on the higher side a little more. When you get into litigation support and the scope becomes unclear and there's a lot of discovery and interaction with lawyers and accountants, I mean, you have to
Yep.
start charging hourly because you just don't know. I mean, we had $100,000 project this year because it took us about all summer because of the complexity of an estate situation where tragically a spouse died and they had multiple entities that had to be valued in their estate. So, yeah, you get up to hourly situations, and then risk is a big factor in something like a fairness opinion, where a board might need an external opinion confirming the fairness of a transaction price to offload the risk from the company being sued by minority shareholders dissenting, claiming that the price was unfair. And for that risk assumption, we charge a pretty substantial premium. But our fees as a smaller firm, like myself as technically a solopreneur with a handful of contractors, is probably half as much as or more than a big investment bank charging, their premium fees for that after the transaction that they got paid to do, which sounds like a conflict of interest to me, but what do I know?
Appreciate all that. Well, Greg, this has been awesome. Appreciate all this that you've shared with our audience. We've talked about how a business is valued and owners take note. It sounds like there's about a dozen different ways to value a business. We talked about the obstacles the common myths and obstacles that can come along with valuing a business and helping owners understand that. Talked about strategic value and normalizing adjustments and how to increase the value of business. And then finally, what you seem to have, Greg, is just a very efficient way of getting very good information back to owners with respect to their value at less than what a lot of other folks are charging. And I'll add, you're adding to the 2% of business owners who understand their business value every single day. That I say that statistic shocks me every time I say it again. 98% of owners don't have a true understanding of true transferable value. Only 2% do. So the over 1,000 companies that you valued have contributed to that 2%. That's awesome. Where can folks who are listening, whether they're owners or advisors, where can they get a hold of you? Email, address, phone number?
Sure. the website is Integgra.com with two G's, since there are two G's at the end of Gregg in my first name. And Gregg, G-R-E-G-G, at Integgra with a double G.com. It's my email. And 404-398-3462 on the mobile. So, thanks very much if for hosting. And if I had to say, speaking of that sort of 2% number, I'll throw one interesting stat that we glean from our own research out there as well, in terms of coming up with a reasonable valuation. Since they're based on forecast achievement, the reasonableness of a forecast, we did an analysis of 50 companies that we valued more than once for the 409A option pricing exercise, and to see how many of them actually achieved their forecast, not just in 5 years or 3, but just in the year after the valuation we did, and looking at it the second time. And the 80-20 rule applies again. Actually, 41 out of the 50 did not achieve their forecast in the second year, so 82%. So that tells you that if we blindly accept that those forecasts that are over optimistic, as most entrepreneurs are, then we're overvaluing the company without adjusting for that in some way, in either the multiple selection or the discount rate. So that's super important. If you want a good answer, is to try to be reasonable and take the hockey stick out of the bag.
Yeah, I know you're an ice hockey fan. I think you even play a little bit, but that is so appropriate to see a line go like this and then shoot up. That's going to be us. We're going to be the rocket ship that takes off.
Yeah, it's good to put some math and numbers, to that. Yeah, but that's a real problem.
Yep. Well, folks, that's a wrap for today's episode of the Exit Teams podcast. A huge thank you to Gregg Ficery for sharing his insights, especially at a time when proper business valuation can make or break a business sale. If you're a business owner thinking about your next chapter, now is the time to start building your advisory team. You can learn more in my book, Exit Teams. Build a team of advisors for your business sale to get a higher price, available on Amazon. Don't forget to visit exitteams.com for free resources, tools, and a masterclass that can help you prepare for a successful exit. Until next time, sell smart, build your team, and take control of your future.